Hi, I'm delighted to be joined today by Daniel Bell of Bell Financial Solutions. How are you doing, Daniel?
Very well, yourself?
Yeah, I'm good, thank you. We're going to talk today about mortgage affordability. This is an ever-changing subject I've found since I was involved in the mortgage world. So let's start off and consider the sorts of income that are taken into consideration. So there's the obvious stuff, such as what you earn from your job, but mortgage lenders sometimes will take other income into consideration as well, won't they? Do you want to run through what those sorts of things are?
Yeah, absolutely. So every lender takes into account different types of income, but broadly, most types of income can be taken into account by all sorts of lenders. Employed income, so income that you earn from your employer, generally all of it will be taken into account, but in different ways and different ratios. For example, overtime, commission, bonuses. Some lenders will take all of it into account. Some lenders may only take, say, half of it into account. When it comes to things like benefits, tax credits, again, some lenders will take it into account, some lenders won't. Some lenders will take different tax credits into account, child benefit, universal credit, working tax, child tax. Some will take, again, 100%, 60%, 50%. It depends on the lender. You've then got additional income such as maybe maintenance payments, formal arrangements, informal arrangements. And again, it varies from lender to lender whether they will or won't take it into account. Lenders have criteria on how long they expect people to have been receiving an income before they do or don't take it into account. I guess in short, all income can be considered. It just depends what lender it is. And again, that's where someone like myself comes into play, because we look at all those different lenders and see, right, based on the income that you've got coming in, you're going to be best placed with that lender because they will use most or all of your income, whereas that lender won't use hardly any of your income, for example. So I guess in short, that's where it comes into play.
So it's about maximizing the income that you've got coming in with the lenders so that you can potentially borrow, if you need to, the largest amount possible. So
exactly.
We've talked about employed income and bonuses and so on, and overtime that may or may not be taken into consideration. Then I guess we've got self-employed income, and also those clients who earn through salary and dividends. Do you want to talk through how that might work?
Yeah, absolutely. So self-employed, again, varies from lender to lender. You've got different types of self-employed people. Obviously, you've got sole traders, limited companies, partnerships. As a rule of thumb, most lenders would expect people to have been trading for about 2 years, and would look for an average of the last 2 years worth of income figures. If we were talking about a sole trader, for example, they'd be looking at the net profit figure. If we were talking about a limited company, they would usually be looking at the salary plus the dividends taken for the last 2 years. And again, for a partnership, the share of the net profit, again, for the last 2 years. There are, however, different lenders that will take into account different figures. Limited companies, for example, self-employed people work in different ways. And that might not be a true reflection of what they are earning. There are lenders that will, for example, take retained profits within the business. Some lenders will take salary plus profit after tax. There are lenders that will take profit before tax plus your salary. There are lenders that will consider income after just 1 year trading, or work off projections. So, self-employed people are a more complex way of being assessed. But again, the knowledge that we have as mortgage brokers, that's where we come into play, really quite key with self-employed people. It's again looking at, right, how does your business or your self-employed income work, and what type of lender is best suited for you based on their risk appetite. What do they look at? What figures do they look at? And therefore, of all your income figures that we have, which lender is going to be best, because which one of them are they going to pick based on the fact that that's how they run their commercial risk. It's about matching you to the right lender accordingly.
Yeah, absolutely. Okay. And then we look at expenditure, because there are some things that lenders will subtract from your income when they're working out what your affordability is. So shall we start off? Do you want to talk through how loans are looked at?
Yeah, so loans, generally lenders will look at the overall balances that you may have in relation to your income coming in. It's what we call a debt to income ratio. But then the monthly payments that are going out. So every lender has their own way of calculating it. There's no simple calculation, but they will look at the monthly payments and then use that as a deduction from the overall loan amount that they would then calculate based on the income that you've got coming in. So as a very basic rule of thumb, lenders will look at all the income coming in. They will then say, have a calculation of what they would lend you, and then all the deductions that we're going to mention, say now, they would then take off that final figure to then give you a maximum borrowing amount.
Okay. And credit cards are, from experience, slightly different, I think I'm right in saying, because even if you say, oh, I'm going to pay all my credit cards off, that doesn't necessarily, with all lenders, cut the mustard, does it?
No. So again, your credit cards, generally seen as slightly higher risk to a lender. There's no fixed end date on a credit card. It's what we call open credit. You can pay a credit card off and then fill it right back up again. Again, lenders would generally look at the overall balances that you have. They would potentially look at how much of the credit you have in relation to your credit limits. But lenders, again, would then take a percentage of your balance and use that as a deduction. So 3% is a nice figure. But again, every lender is different, and every lender has their own calculator. And usually they're, the way they calculate that in the background, we're not privy to. But again, there are some lenders that, if you are paying debt off as part of, say, a settlement or a divorce, then there are lenders that will discount all debt, which is great. There are some lenders, as Tamsin said, that will say, no, we still won't take that into account because we just have to consider that it is still a debt. And then there are some lenders that go down the middle and say, right, well, we'll take a proportion of that debt off the affordability, but we're going to leave a portion of it there just to sort of give us a little bit of comfort. So again, that's where, myself would say, right, this is the type of lender we need to look at, because they're going to, consider the fact that we would be paying all that debt off or whatever accordingly.
Yeah, absolutely. And another thing that is going to be relevant for people getting divorced is, we've talked about maintenance as a receipt of an income, but it's also relevant if you're paying maintenance as a parent, isn't it?
Yeah, absolutely. So maintenance going out as an expenditure is obviously a committed expense, and therefore would be treated very, very similar to a loan commitment. So yeah, it is a factor, and nearly all lenders would take that into consideration. There are the odd lender that wouldn't, and again, therefore, if that was a large amount as a proportion of your income, then that's something we need to consider, and therefore talk to the other lenders accordingly.
Yeah, absolutely. And another thing when we're looking at affordability is the term of the mortgage. So if you've got an existing mortgage and you've been paying it off over 10 years, for example, that doesn't necessarily mean that your new mortgage needs to be repaid over that sort of term, does it?
No, absolutely not. You should consider the fact that your existing mortgage was probably based on two incomes coming into the property, and therefore affordable, maybe over 10 years. Going forward, we should consider that it might just be the one income. Circumstances that will be changing. We've also got to look at retirement ages, etc. The existing mortgage was based on potentially, a different retirement age based on the other party. But yes, the term of the mortgage will have an effect on affordability. If extending the term means we can get you into the property you want, because it means we can stretch that affordability, then that's what we can look to do. But we'll always go through those options and make sure it's still the right thing for you, and we're not putting you in a detrimental position. But absolutely, the term is relevant, and it's something that, as part of giving mortgage advice, it's something we'll always look at and make sure that we're doing the right thing for you. But extending the term certainly can be a good option if the advice is right.
Yeah, and it's not always that the mortgage has to finish at 65, is it?
No, absolutely not. Most mortgages and most mortgage lenders would allow a mortgage to go up to age 70 if your stated retirement age was 70, which the way we go at the moment is quite normal. And a lender would not be asking for any further evidence of retirement or pension income going to age 70 if that was your stated retirement age.
Okay, that's really good to know. And what about if you were older, I guess in your 60s, for example? Is taking out a mortgage at that age still possible?
Yeah, absolutely. Again, depending on the individual circumstances. And I didn't touch on when we were at the income section, there are things to consider, such as pensions. And as part of a divorce, pensions are obviously looked at, discussed, transferred, and lenders obviously do take pensions into account. Mortgages can go into retirement. It's an area that we take more care on, but it can happen, and lenders will consider it, and will consider retirement income. So yes, mortgages can go on for a longer term. They can go right up to age 80 in some cases, on a residential basis. But again, it's all down to individual advice, and it's something that we can look at.
Okay. And what about the amount of borrowing that you take compared with the value of the property? So we would call that loan to value. Does that have any impact on the amount of borrowing that you can take?
Yes. So the more equity in the property, i.e. the lower the loan to value, so the less you borrow in relation to the property value, the more a lender would generally lend, because it's less risk to the lender. For example, if you wanted to borrow 90% of the property value, a lender would be more cautious about the amount they would lend you, in relation to your income. Whereas if you only wanted to borrow 60% of the property value, a lender would be prepared to lend you more against your income, because it's less risk to the lender.
Fantastic. That's brilliant. That's been really helpful. Is there anything else that I should have asked you on this subject of affordability?
I don't think so. I think, again, I've sort of said, but in short, it's different for all lenders, and it changes. Lenders change their affordability, weekly, monthly, for different reasons, for different risk appetites, and that's why we're here, and to obviously guide accordingly. It's not as simple as just 4 times income anymore. Take away a loan. There's lots of different things to consider, and that's why seeing an independent mortgage consultant like myself is the best way to make sure that you're getting the right advice and the best affordability for yourself.
Yeah, absolutely. It's certainly a good idea to take some professional advice when it comes to mortgages, and not just run to your nearest high street bank. For anyone who does want to contact you, we'll put your details in the show notes, and then they can get in touch, and I know they'll be getting great advice if they do that. Thank you for joining me today, Daniel.
Thank you for your time.